Welcome to the LivXplore podcast. If you like what you hear, please hit like and subscribe. Hi, I'm Payne, founder of LivXplore Real Estate and Lifestyle, and welcome to our fourth episode. Today I have with me Isaiah Chass. Isaiah, thanks for joining us again.
Of course, here episode 4, we're finally starting to get the hang of things, and we talk about different things today: interest rates, price reductions, a little bit more.
Yeah, you probably just jinxed it because this is the second time that we've shot this episode. We shot it a few days ago, and the market's so crazy that things are already changing. So last week, the market went a little crazy. Rates went up to 7%, a little bit higher than that, and we're trying to figure out what that means in the market. Now, since then, they've settled down to a really low, like 6.5, 6.75, somewhere around there. So they're starting to settle a little bit. But the market really flipped out a couple weeks ago when rates went up to 7%. And we're just trying to figure out what does that mean to the market.
And also why it happens, why you have such a big jump, and then when it's starting to settle down now because it reacts to things in the future. Interest rates primarily, it reacts to news that's coming later on down the road, and now everyone's over the news a little bit and it's starting to calm down.
Right. Yeah. There was a lot of anxiety, I would say, within the industry, like from business professionals. It felt a lot like 2008. It's not like 2008, but just the anxiety when rates hit 7%, conversations we're having, that energy felt very similar that way. And what's part of what's going on in the mortgage market is that bankers are pricing in the continued the anticipation of continued rates. So there's talk about another 75 basis points being hiked by the end of the year, and then another 75 points going on in the new year. What I'm being told by the mortgage brokers is that's already priced into these rates. So when that happens, it's not like rates are going to continue to go up, although we just don't know. But as of right now, that's kind of what we're hearing from the mortgage industry that way. And nationally, as a result of these higher rates, we're hearing and seeing reports of price reductions. Areas that were very hot, I would say hotter than the average during COVID, like the Austin, Texas, Idaho markets, Utah, Montana, things of the places of those areas, they're really starting to see stronger price reductions, more so than other areas, although we're starting to see price reductions all over that way. Isaiah, you've been looking at those markets, and what have you seen that way?
Yeah, and we were talking earlier that it's not just real estate, anything across the board, anything that is able to go up in value so quickly is able to go down in value just as quickly or see price reductions. So getting back into which areas are having major price reductions, Salt Lake City, for example, a really hot place during COVID, during the pandemic, tons of people moving there. Now we're seeing of all the homes currently on the market, 66% of the homes on the market are seeing a price reduction. Wow. Similarly, you look at Austin, Texas, 64%. Boise, Idaho. Boise, Idaho, 67%. Las Vegas, Nevada, 61%. Now you compare that to the national average of around 40 to 41%, and you realize that that's a really high number. It's when you start getting above 45%, start getting to 50%, that's when it's something that is start being worrisome. But then you look at Bay Area markets that aren't seeing that same price reduction. For example, Santa Rosa, we're only at 39%. Similarly, Petaluma, only 35%.
Right. But we're still seeing price reductions across the board, just not as steep as those probably overheated markets that we saw the last couple of years. So, yeah, it definitely seems that all across the market, things are starting to cool. We had Marin County, which is always kind of like a weird anomaly because you have so much money in that area.
You have the little pockets, Tiburon, Sausalito.
Mill Valley, things of that nature. And we talked about this 3 weeks ago. The market was still kind of ticking along and moving really, really well. And I think a lot of us kind of scratching our heads. That stopped as well since then. So even the higher end market, they're still selling things, but it seems like the steam has really been taken out of that market.
I was just hanging out with Marin agents over the weekend, and they said it completely stopped. I mean, and like you said 3 weeks ago, where we were already sitting back thinking, wow, things have really started to slow up, they didn't notice that.
Right.
And then the past week or two, it came to a halt.
Yeah. No, I know talking with agents down there was kind of frustrating being up here and being
Right.
like, no, it's dead, and they're still moving. So it's like, what's
Right.
going on? But no, now across the board, we've seen everything slow, and it's amazing how the messaging within the real estate industry, but I think all markets right now, I think the messaging has really changed because, I try to keep a pretty good thumb on this, and everything I was saying was like, hey, market's going to drop 10%, something of that nature. That seemed to be like a worst case scenario, and that, there was a strong likelihood that as we go into a recession, it'd be a soft landing. It seems like all of that messaging changed about 2 weeks ago, where now that, there's a lot of anticipation that prices could drop more than that 10%, that, we may see 20% drops and even 30% drops in those markets that were really overheated. Now, that's not to say prices in the Bay Area will drop because, one, we don't have a lot of inventory, which is like everywhere else, but we still have a lot of money around here. And so with that lack of inventory, we're still trying to scratch our heads and see, we just don't know. Our crystal ball is blurry. It will be 10, 20, 25, 30, we don't know.
It's a really weird time because you look at the interest rate side, but then you also have
the inventory.
2 to 7 million homes are needed to be built.
Yeah, exactly. So that's what's so odd that way. So we'll see how it plays out. I don't think the North Bay will be hit as hard as those other areas, but we'll see. We'll see what happens that way. And, as the economy shifts, this will provide opportunities for people as well. That, if you couldn't compete in that crazy home buying spree, as prices drop down, there will be opportunities for you to get into the market that way. So, we've spoken about this on our previous podcast, but we just don't know how things are going to shake out. So I think that with those opportunities there, what we're recommending for people right now is to get ready. If you missed out on buying in the previous market, that's okay. Rates will be higher, but there'll be strategies. You come and talk to us. There'll be strategies about, if the market drops 20%, you're still going to be over a 5-year period in a better scenario if you purchase with a higher interest rate with that 20% drop, and then in 3 or 4 years plan to refinance out when rates come back down again.
And there are still some good loan products that aren't, they're not the 2 3/4 that we saw a year and a half ago, but there are still good loan products that will get you into a home at a relatively reasonable, monthly payment.
Right. Yes. No, exactly. The adjustable rate mortgages, not the same ARMs with the teaser rates that we had back in 2007, 2008, but there's some really good adjustable rate 7 to 10 year ARMs that I think are going to be viable products that way. So, Isaiah, thank you very much for joining us again today, and hopefully we provide a little bit of information about what's going on. Again, don't panic. There will be opportunities out there. And
with that being said, though, everyone that's listening, get your ducks in a row now.
Yes.
Don't sit on the fence and hope that you're going to find a place and be able to write an offer on it the day it happens. Get your ducks in a row. See what you need to do to qualify for a loan, even if that's a loan that you're going to get in 6 months. At least get everything ready. Get your tax returns in order, everything that you'll need for a loan application. So when the time comes in 6 months, 12 months, you are ready to jump on that.
Yeah, that's a great point. And on that note, if you did purchase and you're worried about what's going to happen with the economy and your job or anything like that, it's an uncomfortable conversation to have, but reach out to us. We can help you. We can counsel you on kind of like the best way out of this. I've been through the previous foreclosure crisis and saw what happened there. Saw a lot of people stick their head in the sand and not do anything, and it really hurt them in the long run. If you're worried about losing your job, not being able to make a payment, reach out to us. We can give you some really good advice that way. So hopefully this episode gave you guys some information. If you got something out of it, please hit like and subscribe to help us grow and so that you can see us in the future. I'm Sean Payne, founder of LivXplore, and again, I have Isaiah Chass with me, our founding agent, and thank you very much for joining us.
Thanks for listening, everyone. Let us know if there's anything else you guys want to hear about.
Thanks, guys. Welcome to the LivXplore podcast. If you like what you hear, please hit like and subscribe.